Well, hello everyone. Welcome to today's webinar. I'm Chad Frantzen, CEO of Wealth Builders Investments, and I want to thank you for joining us on today's economic update. I'm going to give just a couple minutes for people to come in from the waiting room. This is a live webinar that we're doing, and want to thank you for being here on behalf of our entire team at Wealth Builders Investments. We're super excited to do this call today. One of the questions we get a lot is just, hey, Chad, what do you and your team think about what's happening in the economy, in the stock market? What's your outlook for the election and so forth? So on today's program, I'm going to be talking a lot about on the economy. I'm going to dig in here in just a minute. We'll give people time to come into the room. Couple of administrative items. We will be taking Q&A. So if you're listening to this live on the program, we're recording this on August 22nd, 2024. So if you're in this event live, we do have a Q&A function on the webinar. Feel free to drop your questions into the webinar. If you're listening recorded, obviously you can't do that, but feel free to reach out to our team if you have specific questions on that. Well, really appreciate everyone being here. And yeah, if you don't mind, as you're coming into the room, drop us a line in the Q&A chat and let us know where you are from, where you're watching the webinar from today. Love to hear where everyone is from. So I'm in Colorado Springs, Colorado. We have offices in Colorado Springs, Denver, as well as in Dallas, Fort Worth, Texas. So great. We've got people from all over, Florida, Connecticut, Arizona. Of course, Woodland Park. We've got a lot of people in the Woodland Park, Karis, Colorado Springs community. So thank you so much for being here. We've got people from Idaho, North Carolina. That's great. I see some familiar names on here. So I see Gary and Cindy. Thank you for being here. I see Sully and Mindy on here and the Wilbanks. That's great. Thank you all for being here. Very good. A lot of Texas and Colorado. That's good to see. Well, now that you know how to use the Q&A function, since you told us where you're from, thanks for being here. Now you know where to go if you want to type in a question. So it's kind of like a classroom setting where I trick you into finding that Q&A chat button. So we're going to get started. A couple of administrative items. We will end probably a few minutes before top of the hour. So we're recording this local time, 4 o'clock Mountain, 5 o'clock Central. We will not go past an hour. We may end a few minutes before then. I will leave some time at the end for question and answer. Oftentimes, if you have a question, 5 other people have a similar question of, hey, Chad, can you clarify what you said on that chart or something like that? So please feel free. We'll get to as many of the questions as we can. And if we miss any, then either myself or someone on the team here at Wealth Builders Investments will follow up with you, but would really appreciate the dialogue. So yeah, if you're just joining the chat, joining the webinar, please drop in the chat where you're watching from. And we really appreciate you all being here. Well, this is pretty timely. We did a lot of these monthly economic updates last year in 2023. We kind of got away from it here in 2024 and really felt like in talking to our team, talking to a lot of you that are clients, it would be very advantageous for us to kick this back up, particularly as we head into the fall of 2024. We're here at the end of summer. Kids are back in school. Vacations are over. And we have a major presidential election coming up in November. So a lot going on both in the U.S. and globally. And so whether you are a current client of Wealth Builders Investments or whether you're just a friend of the network and you follow us, thank you for being here. You can look for these type of emails once a month. We've already got dates scheduled out for the rest of the year for 2024. And the purpose of this type of call is for me to provide you an economic update, kind of the research that our team does to distill it. I may show you a few slides. I'll talk at a high level, and then I'll bring it down even to practically what we need to be doing. So it doesn't matter if you're a current client of WBI or not. We want to give you as much information and help bring clarity out of chaos for the times we live in. So I'm going to be a little technical, but I think I've prepped enough. I think I can distill this down into all the different research areas that we follow on that. So we're going to go ahead and get started. Again, you will, if you are on this webinar, that means you registered for it. You will get an email after the event's over from our team, and it's going to have a recording of this event. So if you have to cut out early, or maybe you're dropping in late, whatever the case may be, you're going to get that recording automatically. And then you will also, I will hopefully remember this at the end, but you're going to get a link from our team in the email after the call. And if you want to set up a phone call with our team, with myself or other members of our advisory team to talk through your personal situation. For some of you, your current clients, and you say, hey, Chad, I want to check in with you and the team on how we're doing with our portfolio, what we're thinking specifically for you. There'll be a scheduling link for that. If you're not a client, you're welcome to use that link if you want to learn more about our services. Again, there's no obligation on that. We just oftentimes in these events, people will say, well, that was great. What do I do with it? How do I take some personal action steps? So you will get that email. That'll have that information in there. What I'm going to do in the chat is I'm going to go ahead and put in the webinar chat the link. You will get this by email, but for some of you, you may want to go ahead and grab this. That is the scheduling link if you want a phone call with our team to talk about your specific financial situation. Now, again, in a webinar format, we've got a lot of people in the room, all different backgrounds, ages, investment goals, different levels of risk tolerance and suitability. So I'm going to be talking more at an educational level. I'm not going to be giving specific financial advice because it really is not going to do you justice if I'm giving everybody the same advice on that. But there will be a lot of things that our team views as critical to being good stewards of your resources, of understanding the chaos that's going on in the economy and with the Federal Reserve. And those are going to be, our viewpoints. And certainly some of those are my opinions that I've gleaned from reading a lot of research, and we'll help you apply that to where you are. All right, well, let's kick in. I do have a few slides. A lot of this I'm just going to be sharing some of this research. This is our economic and market update for August 2024. Now, I do have, since many of you have already let us know where you're from, I have a poll question for you. So you should have a poll that's come up on your screen. It's just two simple questions. And it's kind of like the teacher telling the students, hey, this is the direction we're going. The first question is, do you think that the Federal Reserve will cut interest rates in September? And that's September of this year. Just simple yes or no. I'm going to talk about that. That's been a lot in the news. The second question is, do you think that the United States, the economy here in the US, will experience a recession? So I'd love for you to kind of dive in, answer those yes or no questions. We're going to talk about both of these in the material that I have prepared. Again, the Federal Reserve, again, they create interest rate policy, what's called monetary policy in the US. They meet several times a year. They're going to be meeting September 18th, I believe it is. So first question is, do you think the Fed, which has been raising rates, they haven't cut rates in quite a long time, do you think they will lower rates in September? And the second question, do you think the U.S. will experience an economic recession? And let me clarify that. Do we expect the U.S. to experience a recession in 2024 and 2025, in the coming 12 months, shall we say? So I'll give a minute for I've got several responses already in, and really, if you look at the research out there, the first question, I think there's a lot of consensus on the answer there. The second question, there's a lot of people on both sides of whether the U.S. will experience a recession in the fall of 2024 and calendar year 2025. Well, let me go ahead, and we've got a pretty good amount of answers in here. We'll keep and That's really good. So most people, I'm going to go ahead and shut the poll down. I want to make sure I get into kind of our thoughts, but this is helpful because it helps me um, get input from you before I start sharing our thoughts and some of the research that is out there. But both questions are pretty overwhelming, a consensus of answers. So thank you all for answering on that. Um, so let's take a look. The results here, 78% of folks that answered do believe the Federal Reserve is going to cut interest rates in September of 2024. I'm going to talk about that. I would actually agree with that. I kind of give away my answer. I'll give some thought as to why we think that. Question two, as far as a pending recession in the U.S. here in the fall of 24 into 2025, overwhelming majority, 86% of people do believe the U.S. will experience a recession here in the next 12 months. So thank you for your input. I can tell I've got a really sophisticated audience on the live webinar today because those are really good answers, and certainly you're aware of what's going on in the markets. All right, well, let's go ahead and kick it off. As the first question alluded to, there's quite a lot of activity going on this week. One of the reasons why I wanted to have this day for the webinar, it worked good for my schedule, but it also worked good for kind of what's going on in the economy. As many of you may know, or you may not know, the Federal Reserve, which is the governing body, Board of Bank Governors in the United States, is led by Chairman Jerome Powell. And every year around this time, they have a big symposium in Jackson Hole, Wyoming. And it's often when some major speeches are made, and it's often a very telltale sign for what interest rate policy, or what we call monetary policy, is going to be like in the coming months. Now, that meeting is being held this week. Chairman Powell will speak tomorrow on August 23rd. Again, we're recording this on August 22nd. And there's going to be a lot of news coming out of that. Now, the Federal Reserve, just so you know, the first question of will they cut interest rates, they have 3 more meetings in 2024. They have a meeting in September 18th. They have a meeting on November 7th, I believe it is. And then the last meeting of the year is December 18th. Now, in those meetings, all the other global central banks of developed countries are looking to the U.S. and what their policies will be. So they very much have all ears from other bankers all over the world. So in those meetings, that's when they will communicate if they're what we call dovish or hawkish as far as interest rates going up or going down. Now, remember, whether you're a retiree, an entrepreneur, a student, it doesn't matter. The important thing on this is what the Federal Reserve does with interest rates determines the supply of money. It determines how expensive money is. It determines how much what we call velocity money has through the economy. Now, higher interest rates, as we have all learned in the last couple of years, that's going to be higher borrowing rates for small businesses, higher borrowing rates for real estate, auto loans, lines of credit, etc. So again, money is tight when interest rates are high, and when interest rates start to come down, then money is a little looser. It's a little bit more free to flow on that. Now, we started off the month of August with a bit of a flash crash in the markets. A lot of the analysts, the quote experts all over the world, were really freaking out. We had a really bad week in the stock market and crypto markets the first week in August. In fact, one day the the markets were down over 1,000 points on the Dow. Gold and silver dropped sharply, and even Bitcoin dropped over $6,000. And this all happened the first week of August. There was some employment information coming out, and it really spooked the market. And what you know about media is even in the financial world, there's always people that'll say all sorts of things, right? There were people in the first week of August calling for the Fed to do an emergency interest rate cut of 0.5%, which would be 50 basis points. So now things have settled down. And I'm going to talk a little bit more about that, but we're recording this a couple weeks after that, thankfully so, because a lot of that panic was short-lived, but it does prove a point in investing and in financial markets that when risk is either on or off. And the switch for risk, now when I say risk, I mean volatility in prices of assets. Um, that can be prices in crypto and bonds and stocks, in interest rates and currencies and so forth. It's really like a switch. And so that switch can be turned off for a period of time. And then all of a sudden, just like turning a light switch on in your room at home, risk is suddenly on. So that's something I'm going to go into in my presentation. It's really important for us to be mindful of that risk can be off for a while and then it can be on. What that means is that your resources can see a lot more fluctuations, a lot more volatility when risk gets turned on. And thankfully, risk is currently off, but again, that can change in a moment's notice. Now, as you all know, we do have presidential election coming up. So there's a lot of the markets are already kind of hedging themselves against what will happen there. I'm not going to go too deep into the political side of it. I'm going to share a couple points from a business economic standpoint regarding some policies that have been suggested on that. One of the things that also came out, I don't have a chart for this, but there is growing data telling us that indeed, in primarily through the employment and the jobs report, that the Federal Reserve is going to lower interest rates in September. There was a U.S. Labor Department report just came out, I think yesterday or day before of this recording, that about 818,000 jobs, so a little less than a million, over 800,000 jobs, um, that job growth was declined by over 800,000 jobs more than what the government had originally reported. So let me say that another way, because looking back over the last 12 months, it was believed that there was 800,000 more jobs created than what it turns out were actually created. What that means to us as investors is that the job market is softer than what we were being told. And that definitely telegraphs a likely interest rate deduction. Now, this is a far cry from all these emergency rate cuts. I think what the Fed is going to do is in September, they're going to cut rates probably by a quarter of a percentage point. And we call that basis points. So just so everyone knows, a 100 basis points equals 1%. So when you read that the Fed will likely cut interest rates 25 basis points, that is 1/4 of 1%, 0.25, just so we're clear on that. Most analysts that we follow believe that Chairman Powell tomorrow is going to go ahead and put that out there, that they're going to cut rates in September. But I also believe that he's not going to go so far as to say that, well, we're gonna cut rates every meeting that we have for the next 4, 5, 6 meetings. So I think he's going to play his cards pretty close to the vest. Many analysts, and I would agree with this, We have three more Fed meetings between now and the first of the year. Believe that we will likely see an interest rate cut at least two of the three meetings. Some people even believe all three meetings. I do think it's already baked into the markets based on the bond market in particular and mortgage rates that we're going to see an interest rate cut in September of a quarter of a percentage point or 25 basis points. Now, there's really two major scenarios for the economy. The first is that the economy will continue to kind of muddle along, kind of in first, second gear, right? Um, Something like a 2% annual growth rate for the economy, and that there's some job growth. The other side of that equation is that it's a recession, right? To where the measure by which the economy grows, right? The economy in the United States, how it's measured, it's actually 2/3 consumer spending. So what you and I spend, 2/3 contributes to the overall U.S. economy. There's actually been some studies out that most of the spending right now, the discretionary spending, is being done by wealthier individuals, upper middle class, and that the kind of the blue collar middle class and lower middle class are actually not spending as much because of some obvious problems in the economy, that being really high inflation and cost of food and energy and goods. The federal interest rate right now is 5.25 to 5.5, and we think that that's going to slowly start coming down beginning in September. And I think we will see a few more interest rate cuts in 2025. I think there's still a very real threat that the economy goes into a full-blown recession. And at the end, I'm going to share with you, really my view on where we are today and where I think we'll be between now and the first of the year. I want to share with you now a couple of charts as I kind of move through the presentation. And let me get this pulled up for everyone. All right. One of the I found this slide here really helpful for people. I'm talking about interest rates and what the Federal Reserve is doing. Show you, pull up this slide here for everyone. That was not the slide I wanted, but I'll go ahead and do a plug. That is a Kingdom Finance Show is our podcast. If you're not already subscribed to that, please check that out. We do weekly episodes on that, talking about the markets, talking about values-based investing, impact investing, and we've been bringing on some different guests here from week to week. And that's a great way to follow what we're doing. That's on YouTube, Apple, Spotify, all your normal podcast places. Please check that out. It's a great way to follow us and really keep a pulse on what's going on in the markets and how we're viewing it from what I would call a biblically responsible kind of values-based perspective on that. All right, let me get to the actual slide that I wanted to show here now for you all. This chart here is put out by the St. Louis Federal Reserve. And really this just visually shows you what I just shared for the last 4 minutes. I probably could have just shown you the chart and then, you wouldn't have had to listen to me explain it all. But this is what the Federal Reserve has done on interest rates. Many of you remember the 1980s when we had really high interest rates during the Reagan White House, very high interest rates. Mortgage rates were extremely high then. You fast forward here to where we have been the last several years, and right here, 2020, you can see where interest rates were really flatlined, right? You just see it's flat with zero. That is COVID, right? And then you see back in coming out of the 2008 subprime mortgage crisis, 2008, 2009, and 10, interest rates were reduced dramatically to try and revive life back into the economy. Those are both examples of recessions. That's what happens with interest rates during a recession. Now, the far right of this graph is what the St. Louis Federal Reserve, this is their chart, not mine, but this is graphically what's been happening with interest rates. Again, we saw interest rate hike after interest rate hike. So you see on the far right that blue line just going straight vertical, right? Now, that's where we are today, like 5.25 to 5.5% on the federal funds rate. Now, the projection here from the St. Louis Fed in this yellow line is you see that line starting to roll over and starting to come back down. So that's visually how that works. Interest rates are not going to go down overnight. They're not even going to go down quickly over 30, 60, 90 days. It will be I think what Chairman Powell and the Fed will do, it's going to be a very drawn out, gradual, measured pace of reducing rates. Now, that remains to be seen if that's going to be helpful to allow us to avoid a recession. Again, you can see when we've had past recessions, interest rates have to go much, much lower, right, than 4 or 5% on that. But that's visually what we're looking at there. Now, when it comes to mortgage rates, let me touch on this a little bit. Mortgage rates don't directly follow the federal funds rate. The federal funds rates is an overnight borrowing rate between banks, but it is the linchpin. It's the lead dog when it comes to interest rates in the world. Now, mortgage rates have already started to come back down here in July into August of 2024, because again, markets tend to price in the future, stock market, bond market, mortgage rates on that, right? They don't wait for information. They're processing it. That's how a capital system works. So mortgage rates, I pulled some information for the webinar today, actually seeing, 30-year mortgage rates. Again, these are national averages. They may vary based upon your state. 30-year mortgage rates, which were once closer to 8%, and I don't have the chart for today, but very similar to this chart, are now approaching 6%. So they're on the downhill slide. A lot of that is predicting that this chart, that the Fed rates are going to go down. The current national mortgage rates this week, the 30-year was just a little over 6%, and a 15-year mortgage was around 5.28, 5.3%. Again, those rates do vary. Now, what we have said all along is that equilibrium for mortgage rates is around 5.5% on a 30-year mortgage. I'll share this in my closing thoughts, but I'll put it in here since we're on the chart. If we see mortgage rates getting under 6%, and particularly if we see them getting around 5.5% for a 30-year mortgage, what I'm talking about, we're going to see a lot more demand, a lot more buyers come into the market. We're also going to see a lot more sellers, because some sellers have chosen not to sell because they have a really low interest rate and they don't want to sell and then go buy something at a 7-8% rate. So again, those are positives coming out of the interest rates. The mortgage market is already pricing some of this in. So that's something to be aware of and to continue to follow. Now, I want to show you a couple more slides while I'm doing some visuals here. I've got two other slides I want to show you. They're a little technical, but just visually, if you'll follow me here, these two charts I'm going to show you are two of the charts that I look at for indications of recession. This first chart is what's called the Conference Board of U.S. Leading Economic Indicators. It has an acronym, but it's the leading economic indicators. I think it's like there's the 10 core ones in there, and there's some other ones. But this chart has been around for a long time. This chart has successfully predicted every recession. And so what you'll see here is these red vertical lines. Those are recessions. So if you see 2008 and 2000, you see the early 90s and the Gulf War. You can see in the early 80s during the Reagan administration. You see in the early to mid 70s and the um, Middle East crisis. And when these indicators, again, it's an average of leading indicators. This is not looking out the rearview mirror. These are leading economic indicators. It's called the LEI, Leading Economic Index. If you want to look that up, it's a good one to read about. So I like this chart because when it shows that this index turns negative, this particular, you see where we have it circled here, this index has actually dropped 28 of the last 29 months. And that's the longest streak that it's been negative since the 2008 financial crisis on that. So this is a good indicator for us that we will see a recession. Now, the severity of it will depend on a lot of factors, including monetary policy and the job markets and inflation. But this is a telltale sign for me that we're likely heading into a recession. I think there's a high probability that it's a mild recession, but every other recession we've seen a similar chart pattern. Let me show you one other chart here just to geek out, and then I'll come back to some thoughts on inflation and taxes and the presidential election and potential impact there. This chart is a newer one. I've not followed this one that long. But this particular recession indicator, they call it the Claudia Sahm recession rule. And it's got a lot of popularity for some reason this year. And similar to the last chart I showed you, when this indicator starts to get positive, that this blue line starts to get really vertical, it has successfully the last 9 recessions going back to 1960. There's been 9 major recessions where the U.S. economy is not growing, it's contracting. All 9 of these, this recession rule indicator has turned positive in that it started to go vertical on that line. So you can see that here in 2008, in 2000, in the early 90s, right? You kind of see the pattern here in the early 80s. And that gray vertical bar, just so I'm explaining this properly, that gray vertical bar, that is the recession. And the wider that bar graph is on your screen there, the longer the recession is. You'll see that right here, the number 9 recession, the COVID recession, that's a very small bar. It didn't last that long, right? I mean, it started in April of 2020, and it was a quick recession, and then we got all types of relief on interest rates and things like that. So what we're seeing here, in conclusion, on the far right, this blue line is starting to trend back up, and we think both of these charts definitely give a lot of data that support the U.S. going into a recession. I mentioned at the top some of the jobs report, those 800,000 jobs that we thought were there in the economy and they're not really there. Those start to add up to data points to say, yeah, we are, if we're not already in it, we're going to be heading into a recession. Really the follow-up question is how severe or mild will it be on that? Well, I hope that's helpful. That's probably my 2 most technical charts, I promise. I do have a couple other ones I want to share. I want to talk a little bit about the impact of inflation, taxes, and the election. We'll do a separate, it may be a Kingdom Finance Show episode. We'll do a separate program where we'll talk about the election exclusively. I'm going to make some comments on that as it relates to the economy, since really today's topic is the markets and the economy on that. But that is a bit of the elephant in the room, if you will. And so politicians tend to want to get their hands in all sorts of things. I tend to be personally a fan of less government than more. on that. Now, I'm going to go ahead and show this next chart here. This was President Biden's 2025 budget for his tax plan. And hard to know, what Vice President Harris's policies are going to be, what her proposed policies that she's for or against. I think they're still trying to figure that out. But there has been news that's come out that Vice President Harris has endorsed Joe Biden's 2025 tax proposal. One of those components, and I just want to spend a couple minutes here, is that now remember, when we talk about government spending, part of the major problem we have right now is we have $35 trillion in debt. That represents about 7% of our economy. That's a huge number, and it's going up, every second. Now, that can only lead to either we have to learn as government officials, Democrat and Republican and independent, how to spend less, but it inevitably leads to tax increases. President Biden's plan, which VP Harris has endorsed, we don't know if she would actually follow through on this, is for the capital gains tax rate to go from 20% to 45%. Now, that is significant. Capital gains tax, 15 to 20%. So when you sell an asset and you have a gain on it, this is the percentage. So this is more than double. In addition, some of the other tax policies that the Democratic side of the campaign are promoting, which was under Biden's policies, which are all public record, is increase the capital gains tax from 20 to 45. I'll talk about in a minute my opinion on what that would do to the markets. And then also corporate tax. So C corporations, their tax rates, to increase those tax rates from 23 to I think it's 28%. Now, there's also being floated out there by Biden and Harris a proposed tax. Now, we don't know if this would actually become legislation, right? This is Washington. A proposed tax of 25% on, catch this, unrealized capital gains. Now, I have no idea how this would play out. I'm just reading what's been produced out there from all the different news sources, liberal to conservative. But what they're saying is that there would be an additional 25% tax on unrealized gains. Now, unrealized means that you have not sold the asset, but you may still owe taxes on it. Now, Kevin O'Leary, who's on Shark Tank, he's a investment wealth manager. I do like following him among others. He was quoted as saying just this last week that these type of tax policies would be complete madness. And I tend to agree that this much of a tax increase is not just going to be on the wealthy. It's going to have a widespread effect on middle class, all parts of the middle class, particularly on this chart I'm showing you here, a capital gains tax at 45%. So when you sell stock or a CD and you have a gain on it, you sell a mutual fund, you sell cryptocurrency, you sell real estate, and you have a gain. Let's say you have a $100,000 gain on that. You're going to be paying 45% tax on that versus currently it's 20%. So that's significant in my eyes. I do think if we saw this type of tax legislation from a Democratic White House, I think this would have very negative effects on the capital markets. I think a lot of people, myself included, would look to sell assets before these new tax rates go into effect. And so that would include people getting out of stocks, people selling crypto, people selling real estate that they have large gains on that. So this is something to be aware of. Again, policies change, politicians promise things, politicians mislead us, right? All across the board. But make no mistake about it, when we think about how do we be a thoughtful steward of resources, again, bringing this back to those of you in the room watching this, we have to be mindful of what tax policy is going to be, what interest rate policies are. And that's why I wanted to share this today, because this is vitally important. Now, taxes and inflation are two of the greatest killers of businesses, small businesses, and of middle class families, upper middle class families, of their personal wealth accumulation. Now, this is the last slide I have, and then I'm going to come back to some of my thoughts. I'm going to kind of put this all together, give you my thoughts, and then I will answer some Q&A here as we wrap up. So please feel free to put your questions in the chat, and we'll get to as many of them as we can. Because we have such a high deficit, 35 trillion and counting, and the threat of much higher tax rates, such as this capital gains tax rate, this would not be a policy of the Trump administration, from my understanding. This tax policy would be more of a Biden-Harris administration policy, from what I'm understanding. We also have to deal with inflation. Now, we have to see inflation for what it is. And so looking back, we came through COVID, we came out of COVID. Over the last 3 years, since President Biden took office, Biden-Harris, these are just the facts. I'm not trying to make this overly political. My job on today's show is just to give you economic data and business data. We'll do a whole separate show on the election and pros and cons, what values align where, but these are just the facts, right? So this is how much inflation has gone up for different types of things that you and I consume. Gasoline's up 51%. Now we're going back to 2021 to present, so 3 years. Over the last 3 years, electricity's up 32%. Groceries are up 22%. Rent, for those that rent, the average national rent for a single family home is up another 22%. And man, eggs are up almost 50%. I didn't even know that. We had some neighbors come by selling us eggs. These young ladies were in junior high, and I was asking them how much their eggs were, and they're like, it's $8 for a dozen eggs. We raise them at our farm and bring them out. I'm like, that's great, happy to support you. And my wife was like, man, that's not a bad price, because some of these organic farm raised eggs, it can be upwards of $10. Car insurance has certainly gone up significantly, as has homeowners insurance. But so the point here is this: if we're talking about making sense of making money for making a difference, if we're talking about building wealth, to think of our resources and our finances as generational, as having an impact for the kingdom of God, for our family, for the generations beyond just us and our kids. Taxes and inflation are two huge things that we have to contend with. So I think it's really important as we think through, how we vote, and also how we invest and how we do financial planning for your businesses, for your ministries, for nonprofits you work with, for your family, for your retirement, for education, for kids and grandkids. We've really got to have strategies that are going to be able to fight or go toe to toe with higher taxes and inflation. Again, I hope that's helpful just to give you a visual. I know for some of you that's like, yeah, I know that. I look at my grocery bill, I look at my gas bill. That's not going to be a shocker for many of us, right? All right. So what I want to do now is kind of bring some of this together for you. I know I shared a whole bunch of charts there, so thanks for staying with me. I work with Billy Epperhart here at Wealth Builders Investments, and he loves charts. And so I'm similar. I can kind of get going on charts, but I hope those visuals show you some of our biggest obstacles when it comes to financial stewardship, running our small businesses, making sure we have a good financial plan for our family. Taxes and inflation are not going away. I personally feel like inflation is going to stay stubborn, and I do think taxes, it may not be capital gains tax that goes up under a Trump administration, but I do think we'll see some increase in taxes over the next several years. because Washington cannot figure out how to get its spending under control, which is a huge problem for all sides, all parties involved on that. All right. Well, I want to share a little bit on some of the what I'm going to call technical aspects of the market, and then I'm going to land the plane with I'm going to give you my personal opinion, and again, we'd be happy to visit with you all one-on-one to see how that applies to you. Please put any questions in the chat. I'll get to a few of those here shortly. I do think from a technical standpoint, we're going to see volatility. So you can expect to see price volatility in the stock market, in real estate, in precious metals, in crypto for sure. I think that is going to be here with us. Now, that doesn't mean you don't invest. Let me be clear. Remember, volatility can lead to opportunity if you know what to look for. So let me say that again, because that's really important. Volatility or chaos, change, that can lead to opportunities if you know what to look for. So that's why I'm a huge believer that you work with a team of advisors. I think it's important to have someone like Wealth Builders Investments, certified financial planning team that can kind of help guide you through. Okay, what are we going to look for? Right? We need to be, Scripture talks about being aware of the signs of the time. Right? The sons of Issachar. And so we need to have wisdom, godly wisdom on, what are we looking for in what's happening in the world, geopolitically and here locally in each of our communities, and what's happening in Washington, what's happening in Wall Street. This is really important. Case in point, we had this flash crash in early August. Some of you might have panicked. Some of you might have been like, oh my goodness, here we go again. I need to get out of all my investments. But if you actually had seen what was happening, you might have thought, well, this could be a good time to buy some assets that are a good fit for my overall portfolio on that. Again, looking at the markets, the S&P 500, the stock market, it is near its all-time highs. Gold is at an all-time high. It's over $2,500 an ounce. Bitcoin has retraced down from its all-time high of $73,000. It got down in that flash crash to below 50,000. So that would have been a good time to be picking up a little crypto if you're so inclined. It's now back up around 60,000 at the time of this recording. Oil prices have been in the low to mid $70 a barrel on that. So asset prices are going to continue to fluctuate. I don't want that to concern you, but many analysts out there believe we're going to see a recession. It could be mild to moderate. And historically, of all the recessions, the stock market on average goes down about 35, 36% for the average recession. Now, I'm not predicting that that's going to happen, but that has statistically been the average. Some have been lower drawdowns than others. Some have been much bigger drawdowns than others on that. Now, if that average were to play out as we head into 2025, the S&P 500, it's at 5,600 now. It could go below 4,000. I'm not predicting that, but again, I'm just giving you a historical baseline for that. I want to talk about two of the things real quick, and then we'll wrap up with some questions. I want to talk about consumer sentiment. Now, one of the things I often use this scripture in some of my teaching is King Solomon, who was David's son. He was the wisest and wealthiest man in the Bible. And in the book of Ecclesiastes, chapter 11, verse 2, he makes this statement. He says, invest in 7 or 8 ventures, for you know not what will come upon the earth. Now, fast forward 2,000 plus years later, and Wall Street and the financial community have done studies, and there's been Nobel Peace Prizes on this. It's called modern portfolio theory. They actually proved in a secular capitalist market that what King Solomon said, was true. And they call it asset allocation. And they've done all these studies on it. Now, what my message to all of us is We need to think like that. We need to make sure when we look at how we manage and invest resources that we invest in several different categories, right? We don't put all our eggs in one basket, as the old saying goes. That's one of the things our team at Wealth Builders Investments is very focused on, is researching and finding different types of investments, assets that can work in your portfolio that do not violate your personal values, and that we believe, whether we go through a mild recession or a moderate recession or a prolonged recession, that those assets will be good quality investments to have. Now, King Solomon was wealthier than Warren Buffett, Jeff Bezos, Mark Zuckerberg, Bill Gates, and Elon Musk combined. Present value of King Solomon's wealth was worth more than the five wealthiest people in the world today in 2024. It's interesting to note that several of these people that I mentioned, Buffett, Bezos, Bill Gates, and others, they have been selling out of some of their stock in 2024. Famously, Warren Buffett sold 50% of his Apple stock in the spring, and he's sitting on $277 billion of cash right now, record. Bezos has sold $13 billion of his Amazon stock. The Walmart family, the Walton family, sold over $4 billion of their Walmart stock. And U.S. corporations actually hold an all-time record of $4.4 trillion in cash. Now, what does that mean for you and I? I'm glad you asked. What it means is that we need to be really diligent. We need to have a strategy. So these super affluent people, they still have assets that they're invested in, but they're also taking some chips off the table, if you will. So they're moving some money to cash, and what they will probably do is when stocks go down, they will buy back the same companies at a lower price. That makes sense? All right. Well, I want to open it up to some questions here, and then I'll give my closing thoughts on that. Let me look through the Q&A here. Um, Outlook for gold, silver, and treasuries. Gold and silver we think continue to be a good store of value, and so we like those. In our portfolios at Wealth Builders, we do include allocations to gold and silver. On that, there's multiple ways to buy it, so I think the outlook is positive for gold and silver. Um, Short-term treasuries, we do like short to medium-term treasuries. We call that cash management. And so if we were to take some money out of stocks or out of mutual funds, we would be a big advocate of putting some of that money in gold and putting it into some short-term fixed income, CDs or U.S. Treasuries. I like those a lot. You can still get 4.5% on some of those short-term fixed income investments. Thanks for that question. Outlook on purchasing royalties, especially gas and oil. Thank you, Laura, for that question. Yeah, we do. We like oil especially, and natural gas. There are a couple different managers that we use at Wealth Builders Investments in our portfolio for what are called limited partnership royalties. And I invest in those myself, and we do like them. We're appropriate for clients, so I like that. I like the cash flow they produce. I do think the U.S. has a extreme amount of natural resources that we do need to be drilling and become energy independent from the Middle East. I think most of those I would prefer to work with private companies and not public companies. Not working with Exxon or Shell or Chevron, but actually looking for private companies for that. So I do like that very much. We just look through. Someone's asking about international stocks. You know, U.S. stocks are a little overvalued, right? Particularly large cap, tech, AI related stocks. There are actually a case that could be made, and some of what we do in our portfolios at Wealth Builders Investments is um, emerging markets actually have more value. So there's emerging markets and some international markets that are actually less expensive, if you will. So we actually like that in a well diversified portfolio. Yeah, one of the reasons why gold and stocks are both high at this time is risk has been off, and so stocks are continuing to run up. Gold is continuing to be a strong safe haven um, for a lot of countries, but even in the U.S. here because of what's happening with the U.S. dollar and with interest rates on that. So I don't expect that to change on that. Lots of good questions. I'm not going to be able to get to all of these. I will respond. These are good. We'll respond to these. There's a couple questions in here about geopolitical events. I do think I'm going to read you my closing summary here as we wrap up. But I do think that's the big black swan. I think tax policy in the U.S. Can be very challenging for what happens with the markets. I do think the potential for prolonged world wars is significant. I do think, my personal opinion, I do think if it's a Harris um, if it's a President Harris administration, I think we may see more issues with world wars. Say what you want about Trump, but there were no world wars when he was president, and things were calm with Israel's enemies, which we obviously want to support as Christ followers. So I do think that could change if we saw World War III, if we saw some advanced wars. China taking Taiwan and others, that's going to add a lot of fuel to an already pretty volatile market as it is now on that. Great questions. Thank you all. This is really good. A few of those I did not get to. Again, I'm going to read you my closing thoughts and really appreciate you being here. Again, you're going to get an email after the webinar. Please connect with us if you would like to schedule a one-on-one, if whether you're a client or not. We'd love to connect with you. Again, a lot of this economic update, we need to personalize to where you are, where your personal situation is. All right. Well, with the 2 minutes I have left, I want to end promptly for everyone. Thank you for being here. Let me share with you my closing thoughts. We are approaching, if not already in, a mild recession. The Fed policy will most likely lower interest rates 2 to 3 times between now and first of the year. And we can expect interest rate cuts to be a major theme for 2025 as the Fed navigates a quote soft landing. So we can expect multiple rate cuts next year. Rate cuts in and of themselves will stimulate stock market gains, particularly in small and mid cap stocks. We do, however, see many large cap, tech, AI related companies at very expensive extreme values. However, things are much more dynamic than this. Government spending is at 35 trillion and counting. It's out of control. Inflation for core food and energy is stubbornly high, challenging much of the middle class. Now, economic policies for whomever is elected president in November is a major wild card for the markets, with the potential even of a full-on bear market if Vice President Harris is elected president and follows through on major policy initiatives that we've talked about today, that being price controls on food and increases to capital gains tax and some form of an unrealized gain tax. In fact, the White House administration that's focused on placing price controls on food and banning fracking in the U.S. could lead not only to higher costs, but a huge scarcity in the U.S. economy. If these policies become a reality, and we don't know if they will with the way Washington works, many investors will head for the exits. and the middle class will feel the most pain. Finally, there are other major geopolitical risks in the world today. An expansion in the size and scope of world wars poses a significant risk for black swan events. Now, in my opinion, in closing, in the midst of all this uncertainty and chaos, I do actually see opportunities on the horizon in certain parts of the stock market. I believe gold will continue to be a quality safe haven asset. Also, with lower interest rates, I do think we'll see another bull market run in cryptocurrency and mortgage rates, which we talked about, as they trend closer to equilibrium, 5.5% on the 30-year mortgage. That's going to be positive for the real estate market in the United States, particularly for single family homes. We can expect inventories of homes available for sale as we move into 2025 to continue to increase to higher levels that they were in 2024. Finally, I personally lean to a cautious investing approach that's going to be well diversified with strategic and tactical strategies. That's my closing thought. I want to thank you for being here. And finally, if you want to know how you can create a financial plan that is in line with your values, that is going to take advantage of the volatility and what's happening in the markets, really want to encourage you to reach out to our team at Wealth Builders Investments. And again, please watch for these webinar invites. We'll be having them every month. And we look forward to visiting with more of you next month and hearing from you if you would like a one-on-one. Look for that email. You'll have the recording as well as the link to schedule a call with our team. Thank you so much for being here today on behalf of Wealth Builders Investments. We appreciate the opportunity to serve you. We wish you health and God bless. We'll see you next time.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.